standard cost, variances, and the balanced scorecard. Standards. Standards are very common in business. They go along with budgeting, but they're not the same as a budget or budgeting. And standards, as a very simplified thing, are performance goals. And when we talk about standards, these are going to track along with our manufacturing costs. So we're going to have standards related to direct materials, to direct labor, and also to factory or manufacturing overhead. When you talk about standard cost systems, you're really referring to how much something should or what you think it would cost versus what it does cost. So what you think it should cost is the standard or your estimate of what it would cost. But the actual cost itself is what you really have to pay for it. Okay, we're going to see differences between standard and actual. With the standard cost, again, you're dealing with estimated amounts, what you think it should be, not what it actually might be or what it actually ends up being. Okay, it is what it might be, but again, it's before the fact, so you're not sure of what you'll actually end up with. When you talk about developing standards, then you're simply talking about, okay, for instance, I know I'm going to produce 10,000 units. Well, how much materials do I need for that? How much direct materials? Well, you're going to calculate exactly how much that you think you're going to have and how much you think you're going to pay for it, and you'll develop a standard cost for that production level to determine how much you, again, envision or estimate or think that you're going to have. Later on down the road, you're going to compare that number, that standard, to what it actually did cost you and get a difference. And that difference is something we call a variance. Okay, so that's kind of what we're going to start discussing here. When you set standards with a company, though, it is a joint effort. So you have a lot of people involved, and it can be a very difficult task when you talk about getting a standard cost or per unit of your product that you're making. It involves a lot of people, a lot of different aspects. So you're going to want to get information from all of those different areas and segments and managers and all these different corners of the corporation or your business to set up these standard costs. Okay, so it can be a complex process. So you need a lot of involvement across your organization for this. And there's two types of standards that you can talk about: ideal standards and then attainable standards or normal standards. So an ideal standard is, your best case scenario, that optimal level or your theoretical standard. It may be like your best case scenario, what you would like to do in a perfect scenario, the ideal itself. Okay? And companies set standards at one of these levels, again, at an ideal level or at the normal level. A normal standard is something that's a currently attainable standard under your normal or your expected operating conditions. Okay? So some people go for this idea that ideal standards are better because it's a shoot for the stars kind of a mentality that you give people this ideal standard and that will increase productivity and people will have this high goal to achieve and try to aim for. But a lot of the times you'll find, and you can think about this yourself, but managers look at ideal standards that actually kind of have a counter effect on employees because ideal standards are usually very difficult to meet. Sometimes you can say that they're not realistic whatsoever. They're impractical, or they're shoot for the moon kind of a thing. So you're not really going to be able to attain them. So then that just gets disheartening and you say, well, I'm never going to get to that level, so why should I even try to? Okay, so that can be a big issue with ideal standards. So I don't know of many companies that actually use an ideal standard. You're going to find that in practice you're going to have these normal or attainable standards is what it's going to be different. Now, just because it's called a normal standard or an attainable standard, that doesn't mean that it's an easy standard. So these can be difficult or very rigorous standards themselves, but they are attainable with effort. Okay, they may be challenging, but they certainly can be attained. So that's something that's, again, better for your workforce and more practical from a management perspective. So you're going to see that those are much more utilized than an ideal or theoretical standard. Now let's talk about these specific types of variances. Again, I mentioned before, a variance is just the difference between your standard cost and your actual cost. And when we talk about manufacturing variance overall, we're talking about the total of all three categories. So you'll have direct materials, and you can get a variance for direct materials, and you can get a variance for direct labor, and you can get a variance for manufacturing overhead. When you combine all three of those variances, that gives us a total variance, or a total production variance, or a total manufacturing cost variance. That's the combination of all three of these areas. But we can break these down into each type. And before we go, and I'll give you some formulas for these actually, but let's just think about what happens, okay, for direct materials, for instance, our first one on the list. Why would we say, okay, we've got a standard cost, and why would we have a difference between a standard and what actually happened? What would be an example of something that would cause a difference? So before we go through production, we come up with this standard cost. Again, it's based on good data. I mean, it's based on historical data that we know, things that have happened in the past, good estimates, good information about what's going to happen in the future. But then when we actually go through production and we compare, it's different. Why? Why would it be different? Let's use an example of socks. Okay, easy enough. Let's say we're making socks. And so we're looking at why we might have a variance in direct materials. Okay, and let's say, they're cotton socks, and maybe we use some dye. Okay, that's really all we've got for direct materials. So cotton and dye. Why would we have a difference between standard costs and actual costs? Well, there's really two reasons I can think of. Okay, so just think about that for a minute. We knew, let's say that we were going to make, we estimated we were going to make 5,000 socks. Okay, and we figured out how much we were going to use and how much it was going to cost us, and so we made up our standard cost. Okay? Or not even the total. I mean, you don't even have to throw production. Let's say it doesn't matter the production level, but the standard cost per unit. Okay, we got a standard cost per unit. So why would that be different? Why would our standard cost per unit be different than the actual cost per unit? Again, I only see two reasons for that in general. Now, we can talk about a lot of things, but it's going to boil down to these two. The first one is there's two components to figuring out that standard: how much material and the price. So really, there's a difference between those two things. Did we pay a different price for it, or did we use a different quantity of it? So when we talk about direct materials, you're going to see, and I'll go ahead and change, we have two variances to talk about. We have a price variance and a quantity variance, because those are the two reasons that you'd have a difference in your direct materials figures. Okay? If we say total direct material variance, then we're really talking about the combination of those. Whatever you have as a price variance, and you add in the quantity variance. You may only have one, and that's fine. The other one would just be zero, so the total would be made up of one of those. But there's two reasons that this could be different. Okay? So again, with the price, you have a difference in the price. So you figure out what you actually paid, what was the standard price per unit, again, or per quantity, whatever that is. If we're buying stuff in gallons, or if we bought, cotton or wool in yards or tons or whatever our amount is, okay? That price per that amount or quantity. And then you multiply it by the actual quantity, okay? We've got to isolate the price versus the variance. You can't include it all in one, or you'll kind of mess up your variances. You'll get a little of each in both, okay? So difference between the price times actual quantity. If you get a positive number, that's unfavorable. If you get a negative number, then that's favorable. But let's talk about why that is. Don't just memorize that. I mean, you can, but it makes sense. Look at the equation. Okay, you actually paid $10 for something. The standard was $8. So you thought you were going to pay 8, you ended up paying 10. Is that good or bad? And these are all production costs, right? So you paid more than you thought. Doesn't sound good to me. That's an unfavorable variance, okay? But instead, you thought you were going to pay 8 and you ended up paying 5. That's a good thing. But in this equation, that's going to be a negative, so that would be a favorable variance, okay? Quantity variance. Now we're isolating the differences in quantities. So the actual quantity, subtract the standard quantity, and you multiply it by the standard price. If it's positive, again, that means that you used more than you thought, then that's unfavorable. If it's negative, the opposite is true. Then we have a favorable variance with this. Okay? We're going to see a similar theme with direct labor and, manufacturing overhead. Let's talk about direct labor, though, before we go on to it. Okay? Again, think through why you would have a difference between the standard cost for direct labor and the actual cost for direct labor. And again, I come to two things I can think about. Okay, so think about it. Your direct labor. Why would you have a different number than you thought? What would be a reason? Again, think of a reason. You can wait for me to talk, but think it through and it'll make a lot more sense. Well, one reason is I thought I was going to pay, $10 an hour, but for whatever reason we ended up paying $12 an hour or $8 an hour or, whatever. Or, an average difference. Maybe everybody didn't get paid different. But anyway, you paid a different amount. That's one reason. What if that didn't change? We thought we were going to pay $10 an hour. We really did pay $10 an hour for everyone. What would be another reason that you would have a difference? Well, I would think, what if you estimated that we were going to use 50,000 hours for this period and you ended up using 60,000 or 45,000? So the amount of time that was actually spent working would be a difference. Okay, so for direct labor, you're going to see two variances there as well. We call these a rate variance and a time variance. Okay, the total direct labor variance is the combination of both. So that's the rate variance plus a time variance. The rate variance, again, is looking at, did I pay a different rate? So what did I actually pay versus the standard rate? And then I'm going to multiply that by actual hours. Okay, and again, think about it. If my actual rate was $15, my standard rate was $10. So I thought I was going to pay $10 an hour. I ended up paying $15. That's a positive number, but it's not favorable. That's an unfavorable variance. I paid more than I thought. If it was the opposite, though, and I paid 8 when I thought I was going to pay 10, well, that's negative, but that's a favorable variance. For the time variance, then we're looking at the difference between the actual hours that were worked versus the standard, or what we thought was going to be worked. And we multiply that by the standard rate per hour. Okay, again, positive would be unfavorable and a negative would be favorable. Okay. Manufacturing overhead. So this one can get very complicated. We're going to keep it at the top level for manufacturing overhead. But you can look into and get more information about what's called it kind of looks at the variable portion and the fixed portion of manufacturing overhead. Again, we're going to look at kind of the top level of this one, but there's something called a controllable variance and a volume variance, and those get into more details about the manufacturing overhead. So you can look at that if that interests you. We're just going to talk about, again, kind of this top level. So you want to figure out what your actual overhead is and subtract out your applied overhead. What's the difference between those? And that's going to give you your total overhead variance. And when we say actual, we're talking about both the variable and the fixed component. So we do want to include both of those here. And your overhead applied is going to be based on standard amounts here, standard hours. So again, you can look at the positive, the negative, whatever, but you can also look at under or over applied. If you under applied factory overhead, then that's unfavorable. If you over applied, then that would be favorable. And again, it's a difference between actual versus applied. Okay. So when you just hear total variance or total manufacturing cost variance, that includes direct materials, direct labor, and factory overhead. So the reason for that could be a variety of items. So that's why we need to break these down into, number one, the 3 production costs: direct materials, direct labor, and factory overhead. So maybe all of them have variances. Maybe some are good and some are bad. Okay, some favorable, some unfavorable. So maybe that shows us where we're doing good or where we need to improve. But within that, then we also need to look at those specific variances within each of those costs. Because just because I have a direct material variance, for instance, why do I have a variance? Does that mean that you have a price variance or a quantity variance or both? Were they both favorable? Were they both unfavorable? Was one, So there's so many things, but that's why we have all of these different sections to look at. And the reason we break these down so far, because again, we want good information to make good decisions. And this will tell us, again, where things are going well, where things are going not so well. Some things we may have control over, and some things we may not. For instance, I use direct materials again. If your price changed, was that controllable or not? So if your price was more than you thought it was going to be, is that because you didn't take a discount because your accounts payable clerk or your purchasing department wasn't paying attention and they missed some discounts that they should have gotten? If so, that needs to be fixed. But maybe your supplier just went up in price and there's no other supplier for that, or there is another supplier, but the one you have is the least expensive, or it deals with the quality issue. So the quality of that material for the price is the best that you can find. So you can't really do much about that, but it's still information that's good and good to have. So again, you can make good decisions based on it. But another thing that could happen with, let's say, with direct materials again, since I picked on that one, quantity. Okay, you have a different quantity used than you thought. Again, it's not because you have a different production level. It's be like a quantity per unit. Well, one reason could be, again, the quality of the materials. Perhaps you went with a different supplier because they were cheaper, but the quality is bad. So now you're getting a negative on the quantity variance for that, so it might not be worth it. Or maybe you've got a piece of machinery that's tearing up you need to fix. It's maybe you say you're using lumber and it just mangles it every time it goes through, and you have a lot of scrap now in your production process. That needs to be fixed. So a lot of different things. Or maybe your labor force is not adequately trained and they're doing things incorrectly and wasting that quantity, which also could mean that they're spending more time and they're not being efficient, which would be a direct labor variance. So again, there's a lot of information that's gained out of this process. So it's good to have all these pieces and all these details to look at. Again, the whole point of this is to make good decisions with good information. One other item we want to discuss is the balanced scorecard. And this is a measure that's used in addition to financial. So we've got a lot of financial information. All of this we've been talking about is financial information, these variances. And when we look at these variances, also you'll see that some companies actually build variances into their journal entries of production costs. Some of them make up a variance report. Some of them include it on their responsibility center or reports, or their individual division reports that shows that. Companies can put these on the face of their income statement to show those variances as well. So, but all that's financial. That's good information. But the balanced scorecard combines that with non-financial information as well, and it links performance measures in with their strategic goals for the organization. You can look at a lot of different non-financial measures, but I've listed out the 4 that are most commonly used, and they refer to these as perspectives because these come from different views within and external to the company. The first one is the financial perspective, and that's what we've been spending a lot of time on. Okay, and as accountants, we do, but that's not the only area that we would look at. So the financial perspective should be familiar with, again, and that's the most traditional view. The customer's perspective looks at it from, again, a customer standpoint. So how would a customer evaluate us? What kind of things would they be looking for? And how would we kind of rank with our competitors from, again, the customer's viewpoint? So you want to look at things like customer service. What kind of customer service do you have? You want to look at the quality of your product, your pricing scheme, again, maybe comparative to competitors. You want to look at new products and processes. Well, some here, some of that will be another perspective. New and different products, product innovation, all those kind of things, again, could be included in the customer perspective. Internal process perspective looks at, just like it says, the internal processes of your company. So you're kind of talking about value chain items here. So maybe R&D would be included here. You could look at your production, your actual delivery and transportation. You can look at after-sales services that are evaluated here. So all of those processes, again, from the internal perspective, of the company. How if you have a lot of defective products, that could be something that's looked at here. Waste, we talked about before, how if you're having to scrap a lot of materials, all this could be part of internal process perspective. And then the last one that we have listed here is learning and growth perspective, which is looking at actually an employee perspective. So how well does the company retain its employees? How long are they there? Do they leave often? Is there high turnover? Do they stay with the company for a long amount of time? And also, does the company train its employees and develop those employees? So, training programs would be something that they could look at here. You could look at ethics issues. You could look at employee satisfaction. So, all those would be included in this learning and growth perspective. And again, there's linkages between these. They're not all isolated and individual. They do link together. For instance, we're comfortable or should be comfortable with the financial perspective from this class. And so let's say that you needed to increase your sales, and then that's what you're looking at. Well, okay, if that's a long-term goal, look at some of how these might impact that. We can definitely see the customer perspective would impact that. If you want to increase your sales, maybe you need to improve your customer service, or maybe you need to improve the product quality. Maybe your internal processes need to have some changes as well. Or maybe, you could even look at the employee side also with that. So again, these are not individual. They're all linked together. So it's a linked process when you discuss the balanced scorecard. And this is something that's used quite frequently in business, the balanced scorecard. I think there's a statistic of about half of all of your largest companies in the U.S. use the balanced scorecard in their organizations.